Many traders make use of indicators to help them identify market patterns and trends. Most of these indicators can be categorized as leading and lagging. In today's Forex trading video, I want to show you how to combine leading and lagging indicators. But before I do that, let me first briefly explain what leading and lagging indicators are. A leading indicator is one that is used to anticipate the future direction of a market and thus allows traders to predict the market direction ahead of time. Theoretically, a leading indicator helps a trader get into a market before the price moves. However, in reality, leading indicators are not accurate 100% of the time. This is why traders often combine them with other forms of technical analysis to filter out the highest probability trade setups. A lagging indicator on the other hand is one that provides information about the past movement. It gives a signal once the price has already moved. And while you may think it's useless to know what is happening after the fact, these indicators can still be useful. It is commonly used by trend traders, and while they don't predict any upcoming price movements, they do help confirm that a trend is underway. It gives traders more confidence in their analysis rather than a specific trigger to enter the market. Now, before I move on to the difference between leading and lagging indicators and show you how to combine them, I would appreciate it if you could take 3 seconds to like this video and hit the subscribe button. Do turn on the notification bell so you will not miss any future videos I release. I also have a free day trading guide which you can download via the link in the description below. The most obvious difference between the two is that leading indicators predict market movements while lagging indicators are used to confirm trends that have already taken place. Both leading and lagging indicators have their pros and cons, and therefore you should combine both. This way, the disadvantages of a leading indicator can be compensated by the advantages of a lagging indicator and vice versa. Leading indicators tend to react to price quickly and are thus ideal for short-term traders. But because they are short-term in nature, they are very prone to giving out many false signals that result in losses. Lagging indicators, on the other hand, tend to react slower, and thus traders can expect it to be more reliable and accurate. However, the downside is that by the time the signal is being generated, it could already be too late to enter. This means that traders will witness a move before the indicator confirms it, and the trader will not get the best prices when using lagging indicators. A lagging indicator makes use of historical data as input and thus requires a longer look-back period to determine trends. Trend traders who use these indicators often see this as a necessary confirmation that the price has gathered enough momentum. Other traders who want to catch the best prices may view this as a lost opportunity and thus opt not to use a lagging indicator. Even with the late signals, many traders still prefer to use the lagging indicators as it helps them further validate their trading decisions. It is rather common to see traders use 2 or more lagging indicators to confirm the price trend before taking a trade. While this may seem like a safe and accurate way to trade, do not let this create a false sense of certainty that you know for sure that the market is going to do. Let's have a look at a moving average, one of the most common lagging indicator. For this example, I use a 50-period and 200-period moving average and trade whenever there is a crossover between the moving averages. This is sometimes known as the golden cross or the death cross. When using such an indicator, the currency is said to be bearish when the 50-period moving average crosses below the 200-period moving average and bullish when the 50-period moving average crosses above the 200-period moving average. In this chart example, note that the signals generated by the moving average occur rather late. If you took the first signal and went long after the bullish signal, it would have been too late and you would have lost money. This is because by the time the moving average gave the signal, price has already risen significantly. Now, since we are on the topic of lagging indicators, I wanted to point out that there are tons of false information about the relative strength index, stochastic, MACD or other momentum oscillators. These are not leading indicators. Although these indicators are powerful and do generate a lot of good signals when applied correctly, they are merely a reflection of what price has already done. They do not lead prices. Don't get me wrong, I am not saying to avoid using lagging indicators since they can help you make better decisions. I am saying that you have to understand how they work. And if you're confused, just remember that lagging indicators can only provide signals based on historical data. Since these indicators lag price, you will observe a significant move in the currency before the indicator shows a signal. The truth is that almost every technical indicator is a lagging indicator since it is derived from price. Moving averages, RSI and stochastics are all lagging. Always remember that the price moves the indicator, not the other way around. This is also why they look so good on hindsight when you examine them on the left side of a chart where the price has already unfolded. Leading indicators, on the other hand, are different. They can predict the price movement of a currency pair due to their predictive qualities. A leading technical indicator is designed to anticipate future price moves to give the trader an edge in the market. And while this may sound like a crystal ball, it still relies upon the same common variable, price. A leading indicator will allow you to anticipate future price movements and therefore help you enter a trade before the price starts moving. But because you are anticipating a move before it happens, the market could move in the opposite direction. As a result of this, it is common to witness false signals that end up results in losses. Let's take a look at some indicators or tools that I consider to be leading indicators. Pivot points are leading indicators. They are levels which are used by floor traders to determine the trend of the market and potential support and resistance levels. By noting the current day's high, low and close, you will be able to calculate the next day's pivot point as well as support and resistance level. Notice that I mentioned next day. And that's why pivot point is a leading indicator. What makes pivot points so reliable is that they are based purely on price. Plotting these levels on your charts allow you to know in advance what are the key levels for the next trading day. You can use these levels to determine if you wish to trade the rejection or the breakout. Another tool that is a leading indicator is the Fibonacci retracement and extension. It helps you predict the possible turning points in the market before it happens. Contrast this to a lagging indicator which only generates a signal after the price has already started to move. Fibonacci allows you to act before the fact. Now some traders also consider volume as a leading indicator, but that's only when used in conjunction with price. Other tools that you could use as leading indicators are trend lines and support and resistance levels. These are tools that you can plot on your chart and wait for price to react to. They will tell you ahead of time where the market is likely to be support or resisted. Now, tackling the important question about whether you should be using leading or lagging indicators. This is often a dilemma among traders as they struggle to find a balance between both of them. If you rely solely on leading indicators, chances are you will see a lot of false signals which will hurt your trading account. Rely only on lagging indicators and you will likely enter late and have a poor risk-to-reward ratio. Traders who are looking to scalp the market will tend to favor leading indicators, while traders who want more confirmation will tend to favor lagging indicators. The trick is to achieve the balance is by mixing leading and lagging indicators across multiple time frames. If you can successfully do this, you will be able to have a trading strategy that is far superior to using either of the two types of indicators in isolation. Here's an example of how you can combine both lagging and a leading indicator. You can use a lagging indicator like the 200 moving average and a leading indicator like the pivot point. First, you want to use the lagging indicator to determine the context of the text. So if price is current trading below the 200 moving average, then it is a downtrend and you want to be selling. If price is trading above the 200 moving average, then it is an uptrend and you want to be buying. The next thing you want to do is to look for an entry point using the leading indicator. In this case, I use the pivot point to illustrate this. You can sell a pullback at the pivot point S2, when price is trading below the 200 moving average, in the direction of the trend. You can also use the pivot point to set your stop-loss order. In this case, you might want to put your stop-loss above S1, which is support that was previously broken and now acts as resistance. Alternatively, you can consider using a Fibonacci retracement and an oscillator like the MACD. Again, you can see that the pattern is the same. You always pair a leading and a lagging indicator side by side. You can enter after the MACD shows a crossover when price rejects an important Fibonacci level. As mentioned, you want to try to find the proper balance between leading and lagging indicators to improve the odds of your trade. If you learned something valuable and useful from this video, I would appreciate it if you could like this video and subscribe to this channel. Do make sure to turn on the notification bell so you don't miss out on any of our future videos. I also have a free day trading guide which you can download via the link in the description. Thanks for watching.